We're looking at projections that show billions of XRP might just disappear from the market in the next 12 months. Where's all that XRP heading? It's getting vacuumed up by ETF demand for spot products. Pretty crazy when you think about it. Now, here's what I'm really curious about. December and the Fed. Are they dropping interest rates or what? Because that's kind of a big deal for all of us watching crypto. If they do slash those rates, what kind of chaos are we about to witness in the crypto space? What should we actually prepare ourselves for? I want to zoom out for a minute and look at the bigger picture here. Understanding these macro forces is how we figure out what direction this whole market is moving. So let's start there with the Fed scenario. Break that down properly, and afterwards we'll get into the juicy XRP details. Take a listen.
Yeah, well, we're seeing breakouts in stocks like Apple and, of course, Google.
I love it, though.
So
that's what
there's something for everybody. Yeah, Small caps today are working really well. We see the eco-weighted S&P. So it's not a bad time. The key is that we really need to accelerate, and that might take some time. I envision it's going to be a choppy time until the Fed, and then we can start to likely turn a little bit higher. So I don't think we're out of
December 10th could be the date. Don't go on vacation.
I think we need to bide our time. There's no certainty in terms of a rate cut just yet, and there's a lot of job owning, and it's difficult.
What if we don't? What if we don't? What if we fail to break out? I mean, what's the risk on the downside?
Well, the risk is that we take out these lows. That is the most important level on the whole chart for bulls and bears. If that's broken, then we're going to make an equivalent leg of this down before we move up, which is likely mid-December into mid-January.
Okay.
So it's choppy. There are things that are working.
And that's why you wait.
That's a good news.
And that's why you wait, because of the near-term vulnerability before the Fed meeting.
It's important to be diversified among tech and not just all in NVIDIA.
Same thing with MAGs. It's a very similar chart.
That's
same
right.
thing, same sort of setup.
Yeah, I mean, obviously, if we get over 66.11, that's a great sign. Technically, we've broken a little trend and we can start to move higher. But here, also, a lot of momentum to the downside. So I suspect it's going to prove choppy before we start to turn back up, and likely late December. Yeah.
So overall, the S&P. Love it today. When I came into the studio, only two sectors are down. Even tech was only down like 0.00 something, right? So, I mean, to have a rally with these big names struggling is impressive. And, they don't carry the weight that they did. But it feels like if we close back above this 50 on strong volume, does that mean something?
I don't particularly look at the 50 as being critical, but look, to each their own. In 2018-19 and as well as 2023-24, the 50 was very, very difficult to use as a timing tool. You want to use the slope of the moving average, how far above or below you are to a moving average, not that per se, but it's great to see other groups working today, outside of technology.
We're going to keep rolling here because I've got some other things on my mind.
Why do you think this market can go higher even if the Fed does little?
Well, I think that if the Fed does cut rates, we'll have to watch what the bond market does, because last year when the Fed cut the Fed funds rate by 100 basis points, the bond yield went up by 100 basis points. I think much will depend on, the ongoing data here. We do still get initial unemployment claims. We got retail sales numbers today, which are a little bit on the weak side, and the PPI was not too hot. So I'm not committed, to this notion that the Fed isn't going to cut. I mean, I go with the market's perceptions right now, and so I wouldn't say that it's not going to happen. But I don't think it needs to happen for the market to go higher, because earnings have been phenomenally strong. First, second, and third quarters of this year, analysts expected low single-digit increases in earnings. They came in at 10 to 15%.
But you don't want the Fed to make a mistake, even if all of that is correct, right? I mean, you don't want them to make a mistake. The unemployment rate is up. That's got some people nervous. If they wait too long, they get way behind the curve. That's a mistake, and the market would pay for that.
Well, I think you're right about that, and that's apparently increasingly the perception at the Fed and increasingly the perception of the market. I think the labor market has problems that aren't necessarily going to be solved by lowering interest rates. The idea of lowering interest rates is to stimulate demand, economic demand for goods and services that then boost the demand for labor. The problem with that thesis right now is GDP looks like it's growing around 4% in the second and third quarters. Demand is very strong, and yet the labor market is weak for a lot of reasons that probably defy any solution from the Fed. A lot of it has to do with retiring baby boomers, skills mismatch, a lot of inexperienced workers, and I think companies are going full bore, increasing productivity. That's why GDP is rising faster than payroll employment.
Yeah, but I mean, some would say, yeah, well, imagine what would happen to housing and how that would be freed up pretty dramatically if the Fed was able to.
AI companies are going full throttle, competing like crazy, both here and around the world, to implement AI and machine learning. They're replacing entire departments with machines that can do what people used to do. We're watching whole teams get eliminated as businesses race to stay competitive. And here's the tricky part. You can't just hit the brakes on this. If your company decides to pump the brakes on AI integration, guess what? Your competitors aren't slowing down one bit. They're looking at their bottom line, thinking about their investors, and if swapping out employees for AI services means better numbers, they're pulling that trigger without hesitation. This is happening at scale, and it's only accelerating. So what's the solution here? We need to focus on retraining, more trade schools, vocational programs, getting people into different sectors where they can actually make a living. Most folks don't want a handout and to just sit around at home doing nothing. Look, I'll be straight with you. Yes, there are people who game the system. That's real, and we need to deal with that from both sides. But the majority, they just want to clock in, do honest work, earn decent money, and provide for their families. How do we help those people who are going to lose their jobs to AI? How do we give them a path forward? That's what we haven't figured out yet. If we tackle this now, instead of waiting, we can create a softer landing. But if we kick the can down the road and suddenly have 15 or 20 million unemployed people with no plan, no options, those people are going to be angry, and rightfully so. We're talking about real human beings who've got mouths to feed, bills piling up, rent due next week, basic survival stuff. And you know what bugs me? I'm consuming tons of content out there, and almost nobody's having this actual conversation. It's like everyone's avoiding the elephant in the room. But let me pivot here because there's another angle we need to explore. Fed rate cuts. What does that mean for stocks and crypto? And since we're all here for crypto, let's zero in on that. The crypto after Fed cuts in prior easing cycles during the pivot periods, major crypto assets like Bitcoin and Ethereum have typically rallied as lower policy rates, QE, and failing yields, real yields, push investors towards higher risk and higher beta assets. Here's the deal in plain English. Cheap money changes behavior. When borrowing costs drop, people start getting creative. They take out loans and chase bigger returns in riskier places. Crypto becomes super attractive. Even something like gold starts looking good, though that's more stable. The play is simple. Borrow at maybe 3%, then hunt for 15% or 20% gains elsewhere. We're about to see a tsunami of capital rushing back into these markets. It's going to be intense. But I've got this nagging question. What's the hangover going to look like in 2026? Because here's the reality. You can't keep printing money and dropping rates forever. Eventually, the bill comes due. All this economic stimulation, it's basically gasoline on the inflation fire. And that fire's coming back. Look, inflation hurts everyone. We all feel it. So check out what's happening right now. Even before an actual cut, rising odds of the Fed easing have tended to coincide with sharp crypto rebounds and broad altcoin strength as market front-end liquidity shift. Recent moves in Bitcoin with large caps as December cut odds surge are fresh examples of this dynamic. This is the fuel behind all the 2026 optimism you're hearing. People are convinced we've got runway ahead of us. But here's what nobody can answer. How much runway? When does the music stop? That's the critical piece we're all trying to figure out. Let me throw some stock market context at you real quick. Stocks and Fed rate cuts. When the Fed cuts rates, the S&P near highs with no recession. U.S. equities have usually posted strong, positive 12-month returns on average, reflecting cheaper finance, improving liquidity. The pattern's pretty clear. Fed cuts rates, stocks go up over the next year. Money gets cheaper to access, more capital flows into the system, and markets typically push higher. We'd be foolish to ignore that historical trend. Oh, and here's something juicy. Goldman Sachs literally just told people to start buying dips. Listen to this.
Goldman Sachs really has caught my eye. They are recommending buying the dips in the market. Now, stocks are off their highs. Does buying the dip right now make sense to you?
I think it does. When you look at the Fed potentially cutting interest rates, nobody's talking about them hiking rates. You look at unemployment numbers around 4%, and you look at a situation where the federal government has basically created enough stimulus that they're going to be running a $1.8 to $1.9 trillion deficit over the next several years. I think that's a very good reason to think the stock market will do well over the next few years upcoming.
Inez, welcome back to the opening bid roundtable. We indeed missed you here. So what do you think about this Goldman note? I haven't seen investors really come out here and aggressively buy this dip. It's like they're nibbling around the edges.
They are nibbling around the edges. Thanks. Great to be back here from Spain. I will tell you, look, investors are expecting, the Fed to come in and sort of save the stock market. You saw the rise on Friday.
Okay, so there's something else I need to show you here. Gunjan Banerjee, she's a lead writer at the Wall Street Journal, just pointed out something pretty wild. Wall Street Journal lead writer says TradeFi retail investors are becoming more active in ETFs using leverage. Listen to this.
The retail investors investing in.
I think it's really been the year of the retail investor. We have never seen them quite as active as they are in markets this year. Everyday Americans, mom and pop investors, they've been pouring into broad-based ETFs. Think SPY, right? The Vanguard S&P 500 ETF. They've been buying gold. They're even sticking with the AI trade, which I think is really interesting because we are seeing some doubts creep in among institutional investors about how long this AI frenzy can continue. But individual investors, they are sticking with the AI trade and they're sticking with the stock market. We are seeing purchases track 50% above levels last year.
I'm afraid to ask this question because I think I know what you're going to say. Are retail investors leveraging up?
They are. And I feel like every time I talk to you, there is more and more leverage in the system. And we saw the downside of that in the market over the past few weeks, right? Where a lot of these crypto leverage trades started rippling into the stock market and causing volatility there. But leverage, take it brokerage accounts, crossed $1.1 trillion recently. That's the highest level in records going back to the 1990s.
And I want to be clear, and I'm not advocating anybody borrow money or take leverage to buy equities or whatever, but they've made money. They've worked. I mean, these people, for the most part, with the exception of the April tariff lows and the recent rattling we saw, would imagine these highly leveraged retail traders have done very well.
And I think that's why a lot of them have stuck to these leveraged ETFs throughout the recent volatility. Assets in the...
Remember the crypto leverage apocalypse? People got wiped clean. Well, guess what's about to play out in traditional stocks? The exact same disaster. Timing? Your guess is as good as mine. But mark my words, 2025 is going to be absolutely bonkers. Now, let's talk XRP because Chat Sign Grabber just laid out some fascinating math. After soon, we'll have 7 total funds. Our daily volume kicks up another 35 million per day. We will be in the daily range of $75 to $80 million in average ETF share. That puts us in the range of acquiring 20 to 30 million XRP per day. What kind of average does this give us? 7 funds, 20 million XRP one day, 5 days, 100 million XRP times 4. This is 1 month, 400 million XRP, and then times that by 12, which would be 4.8 billion XRP in 1 year. These numbers are based on where prices sit today, and let's be real, most of us are betting XRP climbs higher. We close out for the holiday with almost a cumulative total of 500 million in ETF volume. Incredible. We should see another 15 million in XRP needed to be acquired in order to back these funds. What does that mean practically? More accumulation happening this Friday. Okay, so XRP ETF numbers just came in. We're looking at roughly $42 million today. Not bad at all for the day right before Thanksgiving. Think about it. Wednesday before a holiday in the States, and we're still pushing 42 million in volume. That's actually really solid activity. Money's still moving even when people are prepping turkey. Now I've got to address something that's been nagging at this channel forever. Tether. We've been talking about their audit problem for years. It never gets resolved. And guess what just happened? S&P took their rating and basically threw it in the garbage. Here's the scale. 1 means you're rock solid. 5 means you're a dumpster fire. Tether was sitting at 4 in this older report. Now they've crashed all the way down to 5. They've literally bottomed out. There is no lower rating available. They're at the absolute worst possible position on this scale. This is really, really bad news. Listen to this one.
So we have assigned USDT a stablecoin stability assessment of 4, indicating a constrained status. And this assessment is the result of a two-part analysis, the asset analysis and also the consideration of additional factors. So let's start with the asset analysis. USDT's reserves consist of a mix of low-risk assets, such as short-term US Treasury bills and cash equivalents, as well as higher-risk assets, including corporate bonds, precious metals, and secured loans. So these riskier assets contribute to potential credit market, currency and interest rate risks. And as of the latest September report, it represented 15% of the over-collateralization ratio. There is also a lack of transparency regarding the asset profile and the creditworthiness of the counterparties holding the reserves. So this raises concerns over the true nature of the reserves risk profile. Due to these concerns, our asset assessment stands at a 4, which reflects the significant exposure to risky assets, as well as limited transparency on the reserve composition.
Limited transparency. Bo Hines dove straight into that exact same mess. Has he lifted a finger to help shine any light on how Tether runs things? Nope, not even close. So let me break this down for you. The S&P Global Stablecoin Stability Assessment Framework publicly covers only a handful of tokens so far: Tether USDT, DAI, True USD, USDE, assigning a score of 1 to be the strongest and 5 to the weakest. In this framework, Tether's USDT was first scored a 4, constrained, and now is downgraded to a 5, which is the lowest category. USDC is viewed as one of the most robust stablecoins in the market, but is based on separate analysis, not published by the stability assessment like one of the USDT. Here's the thing though, Ripple, with their RLUSD, nobody's handed them a score yet. Still waiting on that. But RLUSD just crashed through the 1.141 billion mark in total circulation. That's 1.4 billion overall. And yeah, we're counting 1,100 millions as 1.1 billion here. Now look over here at the reserves. They're actually holding more than what's out there circulating. That's legitimately impressive if you ask me. Okay, so that wraps up the main stuff. Now look, I've been watching some other things play out in the market. I'm kind of a nerd like that. I track everything, and I'm honestly on the fence about whether this is something you'd even care about. Here's where you come in. If these extra market deep dives actually help you out, tell me. I can totally beef them up and make them way more useful. But if it's not your thing, that's completely cool too. No hard feelings whatsoever. I just need to hear from you because at the end of the day, this channel is for you, and I don't want to waste a single minute of your time. See you in the next video.